Welcome to the webinar Money 101, Saving, Borrowing, and Wealth Building. My name is Chris Chaney. I'm a senior financial advisor here. Just a little bit about Fort Pitt Capital Group. We provide custom-tailored financial planning and money management. One of our key strengths is our in-house money management. All of our decisions are made in-house, so we know exactly why we're buying and what. And we take a fiduciary approach, which means that our first and only concern is you and what's in your best interest. We provide a boutique feel, which means that while we have substantial resources, we want to make sure that you know that you're our primary and key focus. So we have an entire team that works around each client, providing that high-level touch, ranging from individualized investment management for individuals, corporations, nonprofits, providing business consultation, but also 401k planning. We do a tremendous job when it comes to retirement plans and helping companies make the most of their assets. And above all, it's all rooted and founded in financial planning, so that when we put a strategy together, we know it's designed to help you realize your goals and your dreams. Our goal is always to provide exceptional client service, taking a holistic approach, being transparent at every point along the way. So a little bit about our webinars. We are not just financial advisors, but we're also a resource. So we like to be the financial concierge for all of our clients. But a lot of times we like to explore other areas in life. Now, this one is going to be focused very specifically on sort of the fundamentals, the blocking and tackling of investing and money management. But we do like to address the bigger life questions because it's just a matter of time. When you're building wealth, you have a lot of issues that you want to address, including estate planning, tax-sensitive investing, coordinating with tax advisors and legal advisors. Sometimes it entails special needs planning, but pretty much whatever it is, we're here for you. So we want to bring together the expertise of a wide range of experts outside of our particular area of expertise, and make sure that we're well coordinated so that you get the best possible solution. Our goal is to make sure that we make complex issues easy to address for you. We provide solutions, but our goal is always to get you to your goal, to your dream, and get you on the right path. So a little bit of information about me. I've been here now over 17 years, but in the business about 30 years. Have a background that is primarily academic, but at the same time, as my clients know, I love them. My focus is making sure they get the best possible results. But that's me. With me here is Paul Brahan, and Paul will give you a little introduction about himself.
Good afternoon, everyone, and thanks for joining. My name is Paul Brahan. I'm a certified financial planner and chartered retirement planning counselor here at the firm. I have 7 years of industry experience. Outside of work, I like to cook, spend time with my wife and my English bulldog Murphy.
Excellent. So real quick, Paul's going to kind of run you through how to interact with this webinar, because when you have questions, we want to make sure we can address them when we have the time to do so.
So if you're on a computer, up in the top right, there is a chat box. There's an arrow here that'll show you where it is. Any handouts and questions will be within those little toggles. You can enter your question down below and hit enter. On a mobile device, it is that top chat box as well, where the little notification and arrow is. And you can enter a question from there.
Do you have any experience? No, sir, I have no experience, but I'm a big fan of money. I like it. I use it. I have a little. I keep it in a jar on top of my refrigerator. I'd like to put more in that jar. That's where you come in.
So our goal today is to help you put more money in the jar. We have two broad categories that we're going to be addressing: assets and liabilities. Assets are things you own, and liabilities are things you owe. So our key concern is to make sure that you make the most of your resources, both on the asset side and the liability side. So let's begin first by taking a look at assets. There are three basic kinds, and because we're going to be sticking to the foundational, fundamental building blocks, we're really going to be focused on the basic types. As you can see, there are stocks, bonds, cash and cash equivalents. That would be things like money market savings accounts, things like that. But there are two additional types that you need to know about. We're not going to be spending time on them per se. Commodities are things like oil, gas, wheat, gold, silver, precious metals, things like that. Um, and then there's also real estate. So there are different ways to invest in real estate. Most people are familiar with their house or if they're renting or owning. But you can also own rental property on top of that, other than direct real estate investments. You can purchase things called real estate investment trusts, which are security versions of the same thing. All of these can enhance a portfolio, but we're really going to focus on the main building blocks of stocks, bonds, and essentially cash.
So let's start with cash. We have savings accounts, money market accounts, and money market mutual funds. We also have checking accounts. Now, the first two here are FDIC insured. So that's the Federal Deposit Insurance Corporation, which covers your deposits up to $250,000 per account titling. So if you're an individual, you have up to $250,000. If you have a joint account with a spouse, you also have $250,000 with that account. So it's important to be mindful of how much you're covered up to per that account titling. Money market mutual funds don't tend to be FDIC insured. So it's important that you know where you're investing your money. Cash as a whole tends to be stable and liquid, and those are the benefits to cash. You have access to the funds, and we typically recommend 3 to 6 months worth of expenses in cash just as a standard emergency fund. If there's a certain need for money, you may want to keep more. Interest that these accounts are paying is secondary. Money markets and money market funds tend to pay more than just standard savings or checking accounts. Money market accounts tend to have higher deposit balance requirements that you have to maintain and start off with initially. So that's something to be mindful of as well when compared to choosing between checking, savings, and money market accounts. So again, cash is for short-term needs.
So another type of investment is bonds. Bonds are a fairly broad category, but the key about bonds is they're essentially loans. So they're loans that you might make to a corporation, to the U.S. government, to an agency of the U.S. government, to a municipality. Their primary determinant, the key thing that there is, are considered income assets because generally they generate interest. That's one of the key features about them. They work similarly to a CD. Most people have an experience with CDs. So CDs are deposits that you make at a bank, and the bank has to promise to repay you at a certain time. And that's pretty much how bonds work. You're loaning money to the government, to a municipality, to a corporation in the form of buying a bond, which they preset by saying, here's what we'd like to borrow your money at. And it has a certain maturity. So that maturity is a period of time before it comes due. If you have the actual bond, just like a CD, at a certain point you'll get your original investment back or a variant of it, meaning you may have bought it at a discount and it comes due at a higher value. But ultimately, the key is that you get your face value back. They're a lot like cash in the sense that they're going to generate income to you, but at the same time, they tend to generate more income. Now's kind of an unusual exception where the short term provides more than the long term. But historically, the long term generates more interest than short term. But unlike cash here, this is something you can buy and sell. So you can buy a bond on the secondary market, buy it on the primary market. The primary market is when you buy it directly from the issuer. The secondary market, you're buying it and trading it from somebody else. But the key aspects that you want to consider when you're looking at a bond are credit quality, which is how capable is the firm or institution that you're borrowing from or lending to able to repay you. That's critical. So the higher the credit quality, typically the lower rate they have to offer you in order to get your money. Whereas a very low credit quality, kind of like your dodgy neighbor who might go to the bank and say, I need to borrow money. And they're going to say, well, you don't get our best rate. Kind of works the same way. If you're borrowing from lending to a company that would be considered low quality, you get what's called a high yield bond. It's a euphemism for what they used to call junk bonds. But the idea is it either has a low credit quality or doesn't have a credit rating at all, typically, but you get higher yields, but there's higher risk. The lowest risk is currently the U.S. Treasury, and so they tend to have the lowest rate. Credit rating is part of it. The term is part of it. You can basically buy a bond that's very short term, Under that broad category, we would consider commercial paper, which is less, like 390 plus less days. Less than a year for the Treasury would be a T-bill. If you're running from 1 to 10 years, that's considered a Treasury note. And typically 20 to 30 years is a Treasury bond. But in the corporate world, it's pretty much 1 year or less is commercial paper, and beyond that, it's just considered a bond with different maturities. If they're short-term maturities, it really gives you the option to wait until it comes due and collect the interest. So it's a nice way to enhance income. There are different types of interest that it pays. It pays you directly in terms of a fixed rate. It can have a floating rate where that rate goes up and down. Or it can be what's called a zero bond, where you buy it at a discount and it accrues value over time, and then you get a higher value at the end. The point of which is that these are income generating assets. They tend to be either secured by an asset or unsecured, in which case you really do depend on the credit worthiness of it. So we always want to look at the credit rating. How strong is the company or institution? What is the term? How long term? That's how long you got to wait for the maturity of your bond, unless it's a bond fund, in which case it's just a pool of those types of investments. And then the interest rate that they're paying. Again, that tends to be the inverse of the credit rating. High credit rating, low interest rate; low credit rating, high interest rate. So that's typically the best way that bonds work. When do you use them? You use them when you need to enhance your cash flow from the portfolio. You do that. Why? Because I need to take money from the portfolio. So it provides a consistent stream of cash flow. And typically, as Paul mentioned, if you're going to need money in the next 3 to 6 months or even a year, you want to keep that in cash. But if you're looking out to 5 years, 3 to 5 years, that typically is where we're going to put money that we want for bonds, because we know that money will come due. We know it's available. It's less volatile typically than stocks. Tends to be less volatile. During periods of extreme volatility like 2008, everything seems to go in the same direction. That can happen. But typically it's more like a teeter-totter. During periods where stocks drop, oftentimes people will flock to bonds, and it just gives you a little bit of a counterweight, so it can potentially reduce overall volatility. One of my biggest concerns, though, one of ours, is that people tend to add bonds to their portfolio too soon. So if I'm working at a company and I'm putting money into my retirement plan and I'm in my 30s or 40s, you're not typically touching that money until you're at least 59 and a half. You have a long time to go. So you don't want to be adding bonds that are just going to dampen the return potential, typically, unless there's a compelling reason to do so. So normally we like to see a much more growth-oriented focus, but that leads us to a different type of investment, stocks.
So stocks are ownership within the company. Stocks, in general, people will also use the term equities. So if you see the term equities, they're referring to stocks here. And stocks are a growth asset. So you're paying for future profits. The return of the stock is the price appreciation, capital appreciation, plus the dividends that the stock may or may not pay. Not all stocks pay dividends. Stocks tend to keep pace with inflation, which is really important, especially now. I know everyone is kind of aware that the price of everything in the last couple of years has gone up. And inflation is the tendency for that to happen. In general, owning the companies that are raising prices tends to allow for you to participate in that growth. So it's important to hold stocks within a portfolio if you want to keep pace with inflation, but stocks are volatile. They tend to go up and down. They don't go in a straight line. We see stocks fluctuate quite a bit, and that's why we only add stocks when we have the risk tolerance for it, but also you're not going to want to add it in a short-term need. So if you have 5 years to wait before you access the money, that's where stocks come into play, and they tend to outperform other asset classes, and we'll look at performance in a little bit here. So just general rules: buy low and sell high. Everyone says this, but it's a little bit more difficult when it comes to actually practicing it, right? That means that you're buying when everyone's pessimistic and selling when everyone's optimistic. It's difficult to do sometimes. And then diversify. So, we'll talk about diversifying in a minute as well.
Yeah, so because stocks can be super volatile in the short term, and you can see that in this chart, the range is substantial. So the first chart that you've got is a 1-year range for the stock market, the U.S. stock market, and you can see it can be pretty high and pretty low. You've got to have the ability to endure that type of volatility. Now, because bonds can be traded, and oftentimes the value of the bond depends on how it compares to the current or future, the outlook for interest rates. In other words, if my bond is paying 3%, but interest rates are looking at 5%, people aren't going to pay $1 for $1 for your bonds. On the other hand, if interest rates go down and my bond is paying 3%, now interest rates are 1 or 2, they'll pay you extra because they can't get that rate. But as you can tell, they're going to range. That blue bar in that 1-year chart, which is on the left-hand side, the 1-year column, still has a wide range to it. So what a lot of people will do is they will blend stocks and bonds. They're trying to reduce the volatility and enhance the return. You tend to get more, there's more return potential with stocks, significantly more return potential, but with it comes volatility. And in a sense, that's what volatility is. The ability to move up also means the ability to move down. As Paul pointed out, when you're dealing with an emotional response as you're watching the market drop, if it drops almost 60%, like it did peak to trough back in 2008 into 2009, that's from basically October 2007 was the high, down to March 9th of 2009, almost 60%. That is hard to deal with. And yet, ironically, the time to jump in is the last time you want to be in there. That's kind of why we have a job. But blending that and recognizing that means that probably if you have a short-term need, a 1-year need, you don't want to be dealing with that level of volatility. Now, if you go to the right, you're going to notice that over a 5-year period, now stocks are barely negative. Barely negative. In fact, the average returns would be right about in the middle, is substantially higher. Bonds aren't a whole lot different. They just don't have the same ceiling. So that's what, again, why people tend to blend. What's interesting is if you go all the way to the right, the 20-year average, the bottom for stocks tends to be equal to about the average for bonds, whereas the average for stocks tends to be the peak for bonds. So again, when you're trying to combine and play off the volatility against the return potential, you've got to decide which one do you have capacity for and what do you need. If I need a higher return, that always entails more volatility, that always entails more risk tolerance. So that's why we take a look at the long-term need, and it might be different in terms of how the portfolio is structured to address the short-term need. But in the end, stocks always climb a wall of worry. We get calls all the time about people saying, hey, have you seen this in the news? Have you seen that in the news? And typically if it's in the news, it's in the price, just so you know. But it's not uncommon during a period, a bull market, when the market is going upwards, to have lots of little incidents and events that cause distress. And in fact, that's what this next chart does. So what you're looking at is the S&P 500 going back to 1980? Yeah. And you're going to see the year end, where it ends at the end of the year, is the gray bar. And then you can see the period of the drawdown. So the drawdown is not really the bottom that it hits. It's just how far it falls. So imagine a 40% drawdown might mean I go from plus 10 down to minus 30, but it's still a 40% drop. So the degree of the drops is the red dots. And you can see typically the red dots are going to be pretty substantial. You can have some significant ones. The lowest one there is in 2008. And that's just for the year. That's not peak to trough. That's just that year. But you can see where the gray bar ended up. And what's interesting is you can see where the gray bar ended up the next year. So there was a sharp recovery. It didn't get you quite back to whole at that point, but you were on your way. And it didn't really take that long in terms of years to get back to whole, as long as you were patient, as long as you endured. This is one of the reasons, again, we have a job, because it gets very distressing during these periods. But these periods are the best opportunity for new money to go in. So we like to take advantage of it. But what's key about this chart is it really shows you that volatility is just built in. It's part of what makes the market work. It's an opportunity to take advantage of. So rather than being scared of volatility, it's recognizing that it serves a purpose. And if you learn how it works, you can start to at least be able to be comfortable with the ride, even though I don't think it's always comfortable, especially during those 60% declines. It's like riding a roller coaster with a blindfold on. It can be tough, but in the long term, it will generate the best return over time. So that return there, it shows about an average drop of 14.2% per year. That's the average decline, which means that's just normal. But the average return over that same period is about 11.7. So think about that. With all the volatility, it still averaged about 11.7% per year. Strong returns.
33 of those 4 years were positive.
So exactly 75%. So that's one of the reasons why we diversify.
So some of the other reasons are, again, risk management, not putting all your eggs in one basket, exposure, participating in the market where it grows. And in recent years, we've seen different parts of the market do well at different times. So it's extremely important. And then selective harvesting. So harvesting what's ripe. And Chris, if you want to give the garden analogy.
Yeah, one of my favorites. So your portfolio is a garden. A well-managed portfolio really is a garden. The tendency is for folks to focus on the bottom line, which would be the equivalent of treating your portfolio as if it was a mutual fund. Now, if I have a mutual fund or an index fund, I can't call up the manager and say, hey, just sell this one. This is up. I don't want to sell the other stuff that's down. Basically, I'm selling the bottom line, which is the aggregate performance of the portfolio. So if the portfolio is down 20%, as it was, the S&P 500 was down 20% back in 2022. If you have to sell at that point, your money's down 20% too. One of the advantages is being able to reach into the portfolio, which again is like harvesting a garden. So imagine it's winter, and I want you to think, if you're living in Florida, you have to imagine being up north in winter, and you look out at your garden, you think, my goodness, this thing's mostly dead, but it's mostly dead. The winter crop is actually ripe, because again, you always want to buy low, sell high. So we can go into the portfolio and selectively harvest those assets that are doing best. And there were investments that made money in 2022. So the idea here is selecting what's working best. What Paul just turned to was kind of a list of all the different general types of investment categories. You can see that's a lot more than we're talking about, but all these different types of categories. And what works in one year may not work in the next year. So again, like a garden, you always want to harvest what's ripe. You don't want to dig up your seeds, because that's the next season's harvest. That's the next season's growth. So we don't want to sell a little bit of those. Just sell what's ripe, trim what's ripe, sell high, and fertilize what's out of season, because that's going to be the thing that works next. But you never get to know that in advance. If somebody did know that in advance, they'd have all the money. And I don't know anybody who has all the money. So you can see from this chart, just year over year, how things change places. Some things become fairly inexpensive. The tendency is to overlook them, but actually that's going to turn around when the season changes and be perhaps one of your best performing assets. That's why selective harvesting is so critical. Yeah. So how do we blend these assets together? Well, it all depends on the nature of the account. One of the key things when you're putting together an investment strategy is recognizing what is the character and purpose of the specific account. Most people have different types of accounts. They'll have a personal account. That's an after-tax account. That's an account that's subject to recurring taxation, but it's easily accessible. They'll have retirement accounts that are built for later, for obviously retirement. And they might have a Roth IRA, which in many ways is the best possible investment account. So the first one we're going to take a look at is really the personal account. So as I said before, these things are subject to taxation. So if you generate capital gains, interest or dividends, that information will be sent to you in the form of a 1099. That'll be included on your annual taxes. You're going to pay obviously taxes on them, but you have unrestricted access to them. And because you have unrestricted access, this tends to be the portfolio that we prefer to have be the most conservative. That doesn't mean conservative, just the most conservative for you. I've had people who are fairly young and we still have a fairly growth-oriented portfolio, but the personal account will be the most conservative option for them. So that's the advantage of that, is that you can get to it when you need it, and we just need to be ready for that potential need if there's a 1 to 5 year need, and we'll structure it accordingly.
So we'll talk about retirement accounts, the other type of account. So looking at just general IRAs, traditional IRAs, 401ks, 403bs, TSP plans, these are tax deferred accounts. You're putting money in pre-tax. It's coming from a lot of times directly from your salary. You're deferring that salary to a later date when you access this money. And at that point, it's going to be taxable to you. There are penalties for accessing it before that date. There are some exceptions, but in general, it's age 59 and a half. After that, you're able to access without penalty. At that point, you're paying full income tax on any distributions that you take, those withdrawals at whatever your income rate is at that time. Typically, it's lower. There are some, circumstances where it might not be, but when you're not working anymore, your income is less. You are forced to take money from these types of accounts depending on your age, which is known as the required beginning date. And these are called required minimum distributions. You may have heard RMDs for short. So depending on your age, as I said before, will dictate when you're taking it. If you are born before 1950, it's age 72 or 70 and a half. If you were born 1951 to 1959, it's age 73, and 1960 or later is age 75. So there is an exception to that, and those are active participants in an employer-sponsored plan still. So those are who are still working. The last type of account I wanted to talk about were Roth IRAs. There's a lot of buzz around Roth IRAs, and for good reason. They're the perfect account. They are tax exempt. So you're putting money in after tax. So you've already been taxed on this money, which allows it to grow then tax exempt. When you're accessing the money, again, as long as you hold it for 5 years or to age 59 and a half, it depends based on when you open the account, that money is tax free to you. Because of that, we want to grow this account for as long as possible. We are typically going to be as aggressive as possible within these accounts. That's why a lot of young people are going into these accounts, because they have a long runway to grow these accounts for. So depending on your circumstance, will dictate whether a Roth makes sense for you.
So one of the questions we've got is, when does it make sense to do a Roth conversion? Typically, because you're using after-tax or taxable assets, it makes a lot of sense to consider a Roth conversion when your income is lower. So typically, when people retire, before they hit required distribution age, there may be a gap in between. So let's suppose you retire at 70, but you're not going to hit your required distribution age at 75. Why am I holding up my fingers? Well, your income goes from here to here. And then when you turn 75 and you have to start taking required distributions, you must take the distributions. That's determined by a formula that the government uses, applied against the year-end value of your retirement accounts, and then that much has to come out. So if you have substantial retirement accounts that you've built up over time, you may have a substantial required distribution. That makes your income jump up. So during that trough period, that's a great time to selectively roll out or convert a portion of your retirement money from taxable, that is the money that will be taxable when you pull it out, over to tax exempt, in which case we're talking about the Roth IRA. That's an optimal time. Now, because the Roth IRA is so compelling, it is tax exempt. When you pull that money out, you're never going to be taxed. And no one knows for sure what tax rates are going to look like in the future. I know a number of advisors, not just financial advisors, but tax advisors, who will say, convert as much as you can into a Roth. Because if tax rates go up as expected in the future, that'll just be a tremendous bonus. But obviously, as Paul pointed out, we want that money to stay invested as long as possible, because you are paying taxes on the conversion. And to be able to recapture the benefit of tax exempt growth, it's ideal to keep that invested as long as possible. So during that trough period, selectively siphon off, as it were, portions of your retirement account. We work closely with the tax advisors, because we don't know your whole financial picture. The tax advisor has a good sense of that side. We have a great sense of your portfolio. Working together, we can identify what's the optimal amount to convert from, again, retirement accounts to a Roth account, to a Roth IRA. And that way you lock in the tax rate at that particular point for those assets. And then that money going forward is exactly tax exempt. But kind of going back one quick step, when Paul talked about your retirement accounts, he noted that you pull out money, you're going to pay ordinary income on that money. So if I'm pulling out $40,000 or $50,000 a year, that goes right on my tax bill, and just as at the same tax rate as when I earned it. That's ordinary income tax. So because that's expensive, we tend to find clients like to minimize the amount that they're taking just to what they need, whether they need it personally or they have to take it because of required distributions. So imagine you're taking out $20,000 and you're in the 22% marginal tax bracket. That means I'm going to be, of that $20,000, $4,400 of that's going to the federal government in terms of taxes, at least in this scenario. Now imagine I can look at my individual account, because as we said before, that personal account is already taxed to some degree. I can look at an asset and say, hey, here's a stock in here that's more than doubled. So let me sell a portion that's doubled. 10,000 is your basis. That's what's already been taxed. It's now grown to 20. If we sell it, that extra 10,000 is the only part that's taxed. It's taxed at what's called a long-term capital gain if you hold it for more than a year. That's 15%. So in order to get 20,000 from a taxable portfolio, you're going to, as I said, 15% on a $10,000 gain, not on the first 10,000 that you've already paid taxes on, at least in this scenario. That's $1,500. So my question to you is, would you rather pay $1,500 or $4,400. Clearly $1,500, $1,500. It's much better. That's one of the reasons why we always stay a little more conservative on the personal assets, because that's going to be your first go-to. It's less expensive, less constraints. Your IRA is great for building wealth, but very expensive once you start to need it. So the question then becomes, so how do we build this wealth? So generally, we want to get to the point where your money can make money faster than you can make money. So how do we build that? First, spend less than you make. That's not easy, but you want to pay yourself first. So imagine giving yourself 10% or 8%, sending that to your retirement plan and learning to live on the rest. Once you're used to it, you'll just get acclimated. It's easy. So typically we recommend maximizing your retirement plan contributions. Why do we want to do that? Well, you get an immediate tax benefit. You're building your assets for retirement. One thing to remember, and this is really critical, your retirement is the most expensive thing you will ever buy. Add up all the houses, cars, vacations, add them all together. Your retirement, if you live a fairly reasonably lifespan, is going to be the most expensive thing that you buy. This is why it's important to start as early as possible and to maximize your retirement plans. Now, as you can see from point 4, remember that the markets are volatile. You want to remember that there are periods of time when the storms happen. They will happen, and they will pass. The key is to make sure you've got good quality investments that can endure the storm and then not only go on, but then go on to new highs. So remembering that markets are volatile is just part of the process. So one way to take advantage of volatile markets, especially in your retirement plan, is just to be contributing monthly. So if you're making monthly contributions, the great thing about this, and it is tremendous, is that you're buying in when the market's dipping. So when the market drops, if you're making a retirement plan contribution, you want to take advantage of that market drop. You now get more bang for your buck. That's the best opportunity. That is a great way to buy low and sell high. So setting up what we call dollar cost averaging, recurring contributions to an investment plan, to your retirement account, is a great way to do it. And then just diversify your investments. So here the point is that you want to selectively harvest what's needed when you need it. So again, I want to go back to 2022. So in 2022, the market as a whole was down 20%. So if you had an index fund, you were down 20%. But within the market, pharmaceuticals, energy, healthcare, a bit redundant there, but you had a range, and some financial services companies did well, made money. So by being able to go into the portfolio and harvest what's up, we can leave alone those parts that are significantly down, because the average tech company might have been down 30 to 50% in 2022, but boy, did they rebound. If you sold even one share of that back in 2022, you missed all the rebound, and it was substantial for some of the better companies, really substantial. So you don't want to harvest what's low unless you have a compelling reason, like such as saying, hey, I need a tax loss, in which case you want to jump back into it. That's on a taxable account. Or if you're saying, we no longer believe in this investment, let's make a change. But you got to be careful. There's no investment that works all the time. There just isn't. They all have their seasons. As Paul mentioned, if you even look at the S&P 500, it makes money 75% of the time, 33 out of 44 markets, but you've got to endure the sometimes nasty 25% that are kind of tough. So reason to diversify, because different markets and different stocks and companies work at different times. And then ultimately, the most important is to tailor the strategy so that it matches the character and purpose of your account. If you might need access to it like you would with your personal account, it should be more conservative, so you can lean on those conservative assets when markets are down. If you're not going to be touching it for a long time, or like a retirement account, just taking out a modest portion, which leaves most of those assets invested for a longer time, you can have more money in stocks, more money in growth assets, be a little more aggressive in your overall posture. And then if you put money into a Roth, it's really the last account you want to touch. It's the perfect investment account. We hate to pull money out of that unless it's absolutely necessary or prudent, and it's just ideal. In fact, if you want to pass something on to the next generation, that's the account to do it. It's tax exempt. It's the perfect investment account. So that should be typically your most aggressive. But I can't tell you the number of times I've sat down with somebody who comes in to see us. We take a look at the portfolio, and we're seeing a strategy that's more or less replicated across all three accounts, even though they serve radically different purposes. So you keep in mind the purpose and match it and tailor it to the strategy.
Chris, I want to add a point about the S&P. A lot of people right now are recommending you invest into the S&P, just into index funds. And as Chris mentioned, 25% of the time, these funds are down. So where do you pull from when you need money from an index fund? Well, you can't selectively harvest, and that's why selectively harvest, being able to pick what Chris said, the winter crop, whenever the market is down, allows you to pick from gains and allow those stocks to rebound.
It's incredibly helpful. But even when people use funds, they're still going to diversify. Nobody who has significant money tends to put all their money in one fund because then you're pretty much throwing the dice when you need the money. So diversification is always prudent. Now, right now, one of the things that's characterizing the current market is a high degree of concentration, and that happens from time to time, where it's just a narrow band of investments that are driving all the returns. That's when diversification doesn't seem to work, but that only lasts for so long. And then we have a period of high volatility when diversification may work. And over time, it tends to work really well just because it gives you more options about what to sell, when to sell it. Remember, the moment you sell something, the moment you sell a share, it's done. If you don't sell it, it can change tomorrow. For better or for worse, it can change. So if something's really beaten up and we really believe in it, we're patient. And again, we may add to it and we just may hold it. But the point is it can radically change as the environment and the weather changes. So just selling at a certain point, as soon as you sell it, you've locked that in. So you want to tend to lock in the winners as much as possible and avoid the things that momentarily are out of favor. What's curious, as I mentioned, is the winter crop is great when it's tough outside, when it's really nasty in the market. And yet, ironically, in the summer, it's the one that people tend to complain about. It's like, why do I have that? Well, you have that for rough weather, and you never get to know in advance when that's going to happen.
Great point.
So borrowing is the other side of the ledger. We've been talking about building assets, and it's really critical. The younger you are, the more aggressively you want to build assets. And by aggressive, I mean you want to save as much as you can. Time is the biggest factor. Compounding makes a huge difference. So if we have an asset that grows like stocks do over time, and as I mentioned before, going back to 1980, you're looking at over 11% a year. Boy, imagine if you're dealing with compounding over time, 30 years, 40 years. That's tremendous growth. If you're starting later, you have to work to almost make up for it. People who start extremely late are basically prepaying their retirement, the cost of their retirement, because they don't have the time to allow returns to generate real meaningful compounded returns. So that's on the asset building side. But most people are going to need to borrow at some point. They will. You're going to need to borrow to buy a house, to go to college, typically, to buy a car, to buy a computer. Well, hopefully not to buy a computer, but you may. But the point is, there's kind of a difference in, am I buying for what I would consider a capital expense, something that can help me make more money, something that can increase my productivity, or am I buying for an operational expense, going to dinner? People oftentimes use credit cards. As long as you're paying it off, fine. But the idea of carrying a float for operating expenses is unwise. Borrowing basically puts you in a position where you owe somebody else the money. So the key thing is when you're looking to borrow is, what am I borrowing it for? Ideally, it's for a capital expense, something that can help you make more money. And again, a car may not be is going to be a depreciating asset, means its value goes down over time, and actually immediately if you drive it off and it's brand new. But ultimately, it can be useful in getting you to work and taking care of necessary needs. And the second question is, how much does it cost me to borrow? So there's fairly inexpensive and there's very expensive. So typically, people can borrow against their house. You can borrow against a taxable portfolio. There are things you can borrow against that are secured by the underlying asset, and that usually comes at a much lower interest rate because there's something behind it, something that the lender can get their hands on, so to speak. So if you have a home equity loan or home equity line, in either case, it's going to be a lower rate than something that's unsecured. Perfect example of an unsecured way of borrowing, a credit card. So typically, if you've got a credit card, it might charge you anywhere from 18 to 29%. That is expensive money. So one of our rules, and you can see it right at the bottom, is always use your cheap money. So one of the questions we had was, when should I borrow versus when should I put that money into an investment? So I've got a friend who came up and asked me this question and said, hey, should I get money into a Roth? And I said, maybe, that's great. Fairly low income tax level, and that's a great way to take advantage, especially when they're young. Build tax-free investments, and as you get older, tend to make more money and need the tax deduction of either an IRA or a 401k. But the idea here was she wanted to put money into a Roth, and I said, do you have any debt? And she said, yeah. I said, what kind of debt? She said, credit cards. It's like, no, do not put that money into a Roth. Your Roth might average, maybe if it averages 8 to 10%, I like to be more conservative, but let's suppose it averages 10%. The market averaged a little over 11, as you saw since 1980. That's a great return, but it's not 24%, which in this case was her credit card rating. So the idea is pay down the credit card. That's like getting a 24% return. So if you have debt, it's always use your cheap money. Now, if you've got a mortgage and it's charging 2.5%, my goodness, I'm not in a hurry to pay that down. With inflation over 3%, that's effectively free money. Remember, you got that before. You got that years back, maybe only 3 or 4 years back, but you got that back when interest rates were super low. You've locked it in. It's not changing. And because of inflation, the purchasing power of those dollars, the cost of your borrowing and returning payment just keeps dropping. So in essence, you're repaying with free dollars, as it were. Inflation's at 3+%. You're paying 2.5%. That's super cheap money. I do not want to be using investment assets at that point. It just makes no sense. So, one of the key things about what we do, and this just goes back to what we talked about, is, we want to make sure that we put your needs and your interests first. At every point, our key concern is to make sure that your needs are being taken care of in a way that optimizes your wealth. The way we know we're successful is when a client comes back and says, I am so glad we met you. We hear that all the time. I am so glad we met you. We've met clients who started with a certain dollar value. They've taken out all the money that they ever started with, and they have more money now than when they started. That's the way a portfolio should work over time. But part of it isn't just the portfolio. As you can tell, there's a lot going on outside the portfolio. So we work closely with those advisors, tax advisors, legal advisors, to make sure that all of your concerns are being addressed. And we take the initiative to bring that up in our conversation. So we routinely meet with clients on a recurring basis. And the goal is always to provide you with a solution. Problems are everywhere. Our goal is to give you a solution that's easy, and then to follow through and make sure that gets implemented. So our basic understanding, our basic posture is we're all in this together. So at this point, we do want to let you know that we do have another webinar coming up. The webinar is, as you can see, on August the 27th, Women, Wealth, and What You Need to Know. This is an important webinar because ultimately, this webinar addresses a portion of the population that hasn't always received the best attention. So at any rate, we do have a number of questions, and Paul, why don't you take a look at that first question we haven't yet addressed. We've addressed a couple as we went, but okay. Great.
Yeah, so the question is, I'm about to turn 48 and I have my current retirement contribution at work set up to 50% to Roth IRA and 50% to a 403B. Should I consider contributing more to the Roth IRA versus the 403B? So, first of all, you may be able to make contributions, Roth contributions into the 403B, and I'm not sure if that's what you're asking about. If you're making 50% contribution to the Roth 403B, 50% to a traditional 403B, where you're splitting, the taxation between the two of those, you are able to contribute both to a qualified retirement account, an employer-sponsored plan like a 403B, and to a Roth IRA. So there are a few details there that we'd like to straighten out before obviously making any kind of recommendation one way or the other. But we also like to not just diversify the types of accounts we have. And we talked about that throughout the webinar. It's important to diversify for a number of reasons. But we also like to diversify the types of accounts you have, right? Having traditional, having a brokerage account, having, the tax deferred, tax exempt accounts gives you more options in retirement. And it's good to have options in retirement, different accounts to pull from. Chris, anything you wanted to add there?
Yeah, you want to, whether it makes more sense to weight your contributions to the Roth tax exempt side or to the traditional side that Paul referred to, really depends on your tax exposure. That's a great question to ask your tax advisor. So let's suppose that you're in a fairly high tax bracket. You might benefit from having more or most of your money go into a traditional 403B. In this case, that's for nonprofits traditionally, or 401k if you're with a for-profit company. You might benefit from having most of your money go into a traditional retirement plan because you need the tax deduction. So if right now you're in a higher tax bracket and you think you're going to be in a lower tax bracket later, remember, you're getting a tax deduction at your current high tax bracket. And then when you pull the money out of your traditional account, you're pulling it out at a lower tax rate. So there, the traditional account gives you an advantage. If, on the other hand, you don't think there's going to be a material difference in your taxation between now and then, from a tax perspective, it usually makes sense to split the contribution like you are. One of the things we like to recommend, especially when somebody's young and they're at a very low tax rate, but they have the probability of increasing their income to the point where they're probably looking at, say, substantial tax rates in the future, is take advantage of the lower income years and put that money into a Roth tax exempt. Because later, when you're taxed at a very high tax rate, it's just going to be prohibitive. You're not going to get the tax benefit that you need. So again, if I'm, in a very high tax bracket at this point and think that when I retire I'll be in a lower tax bracket, let's take the tax deduction now, recognizing I'm getting a better benefit now that it's going to cost me than it will cost me in the future. But it's always nice to have both, as Paul said, because there will be times in the future where you're going to want to pull from one or the other. So it is personalized. So one of the things I do want to point out is as we kind of went through all the strategies and how they need to be tailored to the particular account, that's complex. We've discussed a lot of issues here. And a lot of times, in order to know exactly what do I need and how should the accounts be set up, that requires an in-person meeting where we sit down and talk to you about your specific needs and your situation, your timeline, your risk tolerance, as Paul mentioned, and where you want to be and when. If I've got somebody who's in their 40s, but they say, hey, I want to retire if possible by 55. How are we going to make that happen? So it's a matter of combining those accounts in such a way that gets them to their goal. Likewise, we might have somebody who walks in at 50 and says, I've never looked at retirement and I'm going to be retiring at 60 or 65. Well, we've got 15 years. So the more runway we have, the more time we have to work with the markets and what they can do for you, the better and happier the outcome is going to be. So that's critical.
So another question we have here, can your credit score impact your ability to secure a bond?
So when you're buying a bond, they're not particular about, just to keep in mind, remember, a bond, when I say it's a loan, it functions that way. So imagine I'm buying a bond from Johnson & Johnson that comes due in 5 years. Basically, what Johnson & Johnson has done by issuing the bond is requesting me to loan them the money. And they're going to use it for something else and then pay it back in 5 years. That's how that works. So that doesn't really affect your credit score per se. Your credit score is still an issue, but it becomes a key issue when you want to borrow. Now, if you needed to borrow for a bond for some reason for work, or you own a company, or you have issues there, then it might become an issue. But when you're buying a bond, an investment, it won't be an issue.
Right. You're on the flip side of the bond there. So, the company or the government is borrowing money from you in that scenario.
Yeah. So one more question we had was, what do you access first when you need money? And it kind of depends on your circumstances. As we alluded to before, if you are working and you're at a high tax rate and you have a personal account, you will want to access that first. Access that first. Secondly, you might be, you're in that income trough period, but you need income. So again, you're not working, so the income drops. You're not yet taking required distributions. So you can pull money out of your IRA at a fairly low tax rate, and it's pretty optimal to do that. So during that trough period, we usually recommend if you need the money, that's a good place to pull it from. Remember, Roth IRAs, we want to avoid touching until the last possible moment. You really don't want to touch those if you can. Now, typically, this also becomes a question when, as I mentioned, you've got that trough period between retirement and required distribution when it jumps back up. How much it jumps up depends on the size of your retirement accounts. We generally do recommend once you retire consolidating the accounts. The reason is very simple. It is very difficult to create a coherent investment strategy so that you can optimize your investments and harvest selectively when you've got accounts at 2, 3, or 4, or 5 places. It's extremely difficult to do it. It's not easy for us when we're in the profession. It's much harder if you're not in the business or don't have a lot of experience with it. We generally recommend consolidating those accounts so that you can do that. It also cleans up your estate plan, which is something we like to look at. Who are the beneficiaries? Where does this money go? But one key question that always emerges is, when do I take Social Security? So this is one of the things that we look at as well. When you start to need Social Security, that also can cause your income to go up a little bit. Remember, you're retired, you might not be able to take Social Security. You might be younger than 62. So you might not take it early, or you might want to wait. So imagine we've got a couple, and one makes a lot of money and one makes less, much less. Typically, not always, but typically, as a sort of general principle, we recommend that the person who made a lot of money and therefore has a huge Social Security benefit waits longer. You know, you've got your full retirement age. That's the age at which you can take Social Security benefits and continue to work if you wanted to. There's no limit on your income. If you take it before that, you're paying it back. You're paying back like $1 for every $2 that you make. $1 of every $2 of Social Security that you make if you make too much. So it's not really optimal. But here's the wild thing. If you reach full retirement age, in my case about 67, and just wait until 70, right now your retirement benefit grows at 8% a year. Remember the rule, use your cheap money. Well, 8% may not be your cheap money. Maybe it's going to your portfolio or your savings and leaning on that and using that to supplement your income so you can delay Social Security. Why would you delay Social Security? Well, A, it maximizes your benefit if you wait till 70. That's helpful if you come from a family that's long-lived. It's really helpful. And that's part of the equation too. But the other thing is it will protect the surviving spouse, because remember, when one of the spouses passes, the survivor gets the higher of the two, but they lose that lower one. So if there's an income disparity, we usually like to see the high amount wait. So the recommendation here is sit down. We'd love to sit down with you, take a look at your fact pattern, at your situation, and then we can do an assessment and make a recommendation. And that will absolutely help. So I hope this has been helpful.
Yeah, I don't see any other questions. So we do have a couple of slides here. Thank you everyone for joining today. A few disclosures here. So
yeah, and be sure to check the downloads. They're available for you. So more importantly, if you do have any questions, we invite you, give us a call. Give us a call. We have quite a few. The great thing about Fort Pitt Capital Group is we've got seasoned advisors and a very deep staff of financial planners that are there to assist them, to help you tailor a solution that will help you make the most of your assets. So please give us a call, 412-921-1822. We'd love to talk to you. And we really appreciate your time today.
yes, thank you.
Thanks so much.